Hi there, and welcome to another Equity Trust virtual classroom training session. My name is John Bowens, and in this segment, we're going to talk about the three biggest mistakes that we see self-directed investors make when using their self-directed IRAs, 401ks, Roth IRAs, or other tax-advantaged investment accounts. The first is specific to real estate and other alternative investment documentation. So not having the right documents in order and not having those documents titled in the name of the Equity Trust self-directed retirement plan. So let's use an example of investing in real estate. So when you enter into a purchase contract where you're buying a property with your IRA, it's really important that that purchase contract lists the buyer as your Equity Trust IRA, not you personally, not your LLC, but your IRA. So many clients I have seen in the past have tried to put a property under contract personally and then assign the contract to their IRA. That could be considered a prohibited transaction. So your IRA would essentially be distributed January 1 in the year in which that transaction occurred. So you wouldn't want to do that. You want to make sure that from the very beginning, the contract is titled properly. And even if you could amend the contract or draft a new contract, that obviously is extra work, time, energy, effort, and of course, someone's money in order to prepare said documentation. So you really want to make sure you get this right from the very beginning. So what does this look like? Well, when you title a property contract or any other investment documentation for your self-directed IRA, you're going to use Equity Trust Company Custodian, Equity Trust Company Custodian, FBO, as in for benefit of, your name, or your Equity Trust account number, IRA. So some people, for privacy purposes, keep their name off public record. They prefer to use their account number instead of their legal name. So again, Equity Trust Company Custodian, FBO, your name or account number, IRA. If you're using a Roth IRA, you would plug and play Roth IRA. If it's a health savings account or covered education savings account, you would plug and play the applicable account that you're using. If you're using a solo 401k, there's a little bit different naming convention. Ultimately, when you get to that point, Equity Trust can walk you through the specific titling. So in summary overview, very important that you have your documentation titled properly. Another example is for folks investing in loans, buying notes or originating loans, being a private lender or hard money lender using their self-directed IRA. The lender on the promissory note and mortgage must be in the name of the IRA. All too often do I see investors at the 11th hour when they need to fund their transaction, they send their documentation into Equity Trust and we see that it's not titled properly. That's not acceptable. This can put you at an extraordinary amount of financial risk of maybe not being able to process a transaction, as well as the risks associated with the tax efficiency of the IRA. So you really want to make sure you get this right from the very beginning. Also, if you're investing in a private entity, like an LLC or corporation that's privately held, usually you need to fill out what's called a subscription agreement. And under that subscription agreement, the subscriber is your Equity Trust IRA. So you use that same titling. There again, all too often do we see investors make the mistake of not properly titling that investment documentation. All right, so that leads us to the second biggest mistake that we see oftentimes here amongst Equity Trust clients as well as prospective clients, and that is that real estate investors particularly think that they can obtain bank financing, standard bank financing for a property purchase. So what I'm talking about here is you're using your self-directed IRA, you want to buy a property, and the thought process is I'll just go down to my local bank and my banker who I typically work with or mortgage broker I typically work with, and they'll certainly give me a loan to buy this property with my IRA. Or some people will ask the question this way, well, I'm just going to use my IRA as a down payment and then get a bank loan. Well, you may be able to do that, but you have to borrow the money on what's called a non-recourse basis. So your IRA cannot take on, if you will, conventional financing. Because in most cases, your bank or mortgage broker within the underlying documents is going to require what's called a personal guarantee. Personal guarantee is a guarantee that you personally sign. Under the provisions of Internal Revenue Code 4975, you personally cannot guarantee that debt. So you have to make sure, if you're going to borrow money to buy real estate, that you obtain a non-recourse loan. You might want to go online and search non-recourse lenders for IRAs or 401ks. So again, the summary overview here is that you can't get conventional financing in most cases. You're going to have to find a non-recourse lender in order to loan to your IRA. All right, and then last but not least, the third critical mistake that we see made in this industry is funding. And when I say funding, I'm talking about funding in the self-directed IRA or 401k. All too often, investors fail to establish and fund their account well in advance. They call us 2 days, 3 days, 4 days before they need to close on a deal to open and fund their self-directed IRA. Why is this a problem? Number one, if they are in a stock market position, that could be individual stocks, that could be ETFs, it could be mutual funds. It's going to be between 1 to 3 days to settle those particular assets, that meaning liquidate those positions and get them into cash in order to transfer those over to an equity trust self-directed IRA. Additionally, it is not an overnight process. You can imagine you're moving from one financial institution to another financial institution. It is not typically an overnight process just to transfer money from point A to point B. So you are at the mercy, and we are at the mercy of that other financial institution. And all too often, folks wait till the 11th hour, and then they go through the pain and suffering of being worried about not meeting their closing deadlines or having to negotiate with the seller to extend the closing date, or even worse, completely missing out on the transaction altogether. And we see this happen time and time and time again here at Equity Trust. So I hope you enjoyed this material. I know as we talk about mistakes, it's not always easy to hear, but it's really important that this information is communicated to you. Here at Equity Trust, we take great pride and great passion in making sure that we provide the right expectations, we provide the right information, be very clear and transparent about it so that we can help you be set up for success on your next real estate or other alternative investment transaction. So don't make these 3 mistakes like so many other individuals before you. You can take these learning lessons and put them into action going forward. Until the next video training, as always, this is John Bowens from the virtual studio. Keep leveraging compounding interest in the absence of taxation.